I think it's more a question, not what was similar today, it's more what happens in a crash. And there I was studying stock market crashes, gold and silver market crashes, which had happened. And to get a statistically meaningful sample, I had to use crashes of 5% or more. And there were, across gold, silver, and the stock market, there were many, many crashes, hundreds of them, of 5% or more on a single day. So the question really is, what does a crash mean? First of all, let's talk about what happened after a crash. In general, and when I say in general, it was about 2 out of 3 times, markets that had crashed by 5% were significantly higher a year later. And mostly a week later and a month later. Not always, but generally they were much higher. Of course, there was a 1 in 3 chance that they'd be lower a year later. But when they were higher, on the occasions when they're higher, in general, they were significantly higher, particularly for silver. First of all, the market had set itself up for a potential crash at any time, and that could have come earlier or it could have come much later at higher prices. So it's a bit like a forest with lots of dry wood, but you need a spark to ignite it. So what we had was effectively a forest full of dry wood, and the dry wood, as far as silver was concerned, and gold to a large extent too, were what's called stop losses. Now, stop losses are something which can be put in place at the choice of an investor, or are put in place by the exchange, or are put in place by your broker with whom you have a margin arrangement. What a stop loss is it's an arrangement with the exchange that if a certain price is touched, your holding will automatically be sold by the computer without asking you anything. There's no questions asked. Stop loss price is touched. Let's say the top stop loss price on silver was $100. If it touches $100 exactly, your trade goes through. It's the next trade. It doesn't guarantee that you get the stop loss price. You might get less because you get the next trade after it's traded at the stop loss price.
Stop loss orders are designed to limit risk, but in fast markets, they can magnify it. Once a key price level is touched, computers sell automatically. No discretion, no hesitation. In leveraged products like CFDs and futures, brokers enforce these exits to protect themselves, not the investor. As prices slip, one forced sale pushes the market lower, triggering the next, and then the next. Liquidity thins, slippage grows, and sellers receive worse prices than expected. What begins as risk management quickly becomes a cascade. This mechanical selling is how normal pullbacks transform into sudden, violent crashes.
So you might get, if your stop loss is $100, you might get $99.99, or in a very fast-moving market, $99.95, or in an extremely fast-moving market, you might only get $99. So you're not guaranteed to get your stop-loss price, but in most markets, most of the time, you will. So when you are buying on a CFD site, that's a contracts for difference site, of which there are thousands and thousands around the world, and you're buying silver, you only have to put up a certain percentage of the underlying asset that you control. So you might control 100 ounces of silver. You bought 100 ounces of silver, but you only have to have enough cash in your account to cover 10 ounces. So effectively, they've lent you 90% of what you've invested. But to protect themselves, they will have a limit, a price limit, below which you will be automatically sold. So it all depends on how much leverage you're using and how much cash you've got in the account in question. But the minute there's a slight danger of them losing money, and that limit might come at when you've got less than 5% risk left, they will automatically sell you. They won't ask you any questions. It's sold. Now, on the futures exchange, the expectation is if you go below a certain level, you have to put up margin. That means extra money, and you have to put that up immediately to cover yourself. But if you don't, or if you can't, then either they will automatically sell you, or you can choose to bail out or put a stop loss yourself. So that's the dry tinder, the stop losses. So when one stop loss gets triggered, it'll drive the price slightly lower, and that might trigger the next stop loss, which goes lower and lower, and each stop loss triggers the next one. So that's like the forest fire. When one twig lights, it lights the next one and the next one, and then it spreads. But what was the spark which lit the fire? Well, in this case, it was President Trump's announcement of Kevin Warsh. And Kevin Warsh will be the new federal governor, the chairman of the Federal Reserve, in May, when Chairman Jerome Powell resigns or has to resign from his position and potentially might just become a governor of the Federal Reserve. We don't know, by the way, whether he will, because he's said he hasn't made a decision yet. But in May, Mr. Warsh will become Kevin Warsh will become the chairman.
Every crash needs a trigger, and this one came from politics intersecting with monetary expectations. A surprise announcement related to future Federal Reserve leadership altered perceptions around interest rates and central bank independence, at least in the market's mind at that moment. Whether those perceptions were accurate mattered less than the timing. Traders reacted instantly, selling first and asking questions later. That initial drop was enough to trip the first layer of stop losses. From there, the process fed on itself. The spark didn't cause the fire, it merely revealed how flammable the market already was.
Now, the market perceives him, at least they did on Friday when the market crashed, as being a person who would be a staunch defender of the Federal Reserve's independence. Whether the market will continue to have that view or a different view is neither here nor there, because it's still the spark. What mattered was the view the market had on the day at the moment of the announcement. So the spark was it lit the first twig because someone somewhere said, "I'm selling on that." The price went down. The next stop loss got triggered, and one after the other, like a dominoes falling, each stop loss triggered the next one down, and down it went. And there's no stopping it until the stop losses die out, or someone presses the button saying "buy at any price," and that will halt the fall. Of course, they do have circuit breakers on COMEX, but that doesn't always stop the stop losses from triggering each other. So that's what happened. Now, coming back to Kevin Warsh, clearly Mr. Trump has been saying for some time that he wants lower interest rates, and members of the Federal Reserve Board are under attack from the president, or rather from the Justice Department, as a way of intimidating them potentially into doing the bidding of the president. So in terms of appointing Kevin Warsh as the next Fed president, I suppose that Mr. Trump probably isn't expecting him to be a staunch defender of the Federal Reserve's independence. I think Mr. Trump is probably expecting him to do his bidding, but we don't know what conversations took place between the two of them. But time will tell whether he is what people perceived on Friday, or whether he's more of a dove who's towing the line of the current administration. We will see.
To understand crashes, it helps to study many of them. Looking across decades of data in stocks, gold, and silver, sharp one-day drops of 5% or more are surprisingly common, especially in silver. The pattern that emerges is striking. Roughly 2/3 of the time, markets are higher 1 year after a crash, often significantly so. Silver, while far more volatile than gold, also shows the strongest rebounds. Gold tends to fall less and recover more steadily. Crashes feel catastrophic in real time, but historically they often mark emotional extremes rather than long-term turning points.
I think it's more a question, not what was similar today, it's more what happens in a crash. And there I was studying stock market crashes, gold and silver market crashes, which had happened. And to get a statistically meaningful sample, I had to use crashes of 5% or more. And there were, across gold, silver, and the stock market, there were many, many crashes, hundreds of them, of 5% or more on a single day. So the question really is, what does a crash mean? First of all, let's talk about what happened after a crash. in general, and when I say in general, it was about 2 out of 3 times, markets that had crashed by 5% were significantly higher a year later. And mostly a week later and a month later. Not always, but generally they were much higher. Of course, there was a 1 in 3 chance that they'd be lower a year later. But when they were higher, on the occasions when they're higher, in general, they were significantly higher, particularly for silver, much less so for gold, which seems to be a much more stable asset. But then there were far less 5% crashes for gold than there were for silver. I think silver had something like 8 or 9 times as many 5% crashes as gold did. So silver is a far more volatile asset. So when it's going down, it goes down further. When it's going up, it goes up further. So as you said, on the occasions when it went up, the 2 out of 3, it was up like 38% a year after the crash, whereas gold was a much smaller percentage up. I think it was something like 8 or 10% up after a crash a year later. I haven't got the figure in my head because it's not in front of me at the moment.
During a crash, 2 groups dominate the selling. First are emotional sellers, those who abandon positions out of fear. Second are traders who never intended to sell at all but are forced out by margin calls and automatic liquidations. Together, they create an oversold market where prices fall further than fundamentals justify. This imbalance explains why recoveries are often sharp. Once forced selling ends, only willing participants remain. If the underlying story, supply constraints, monetary debasement, geopolitical risk, hasn't changed, prices tend to snap back with surprising strength.
Stock markets also displayed strong upwards movements in the years when they went up, and that again came to this sort of 2 out of 3 ratio. These figures are fairly approximate, okay, because there were variations, but broadly speaking, I think we can take it as a 66% chance that we'll be higher in a year, no matter what it is which has just crashed. What's the reason why that happens? Because as a general rule, when a crash is happening, there's a degree of two things going on. One, there's some panic selling. Those who are saying, I got it wrong, I'm out of here before I lose any more money, I don't care how much, I'm just out. And then the second thing is the people who are forced out by the market, they have no, because they're on margin, they have no choice, the stop losses are being triggered, and they're selling when they never wanted to sell. If they knew this was going to happen, then if they would have had time, they'd have pulled their stop loss and lowered it or done something else. So those 2 groups of people selling basically mean we've got what's called at the bottom of a crash, you always have what's called an oversold market. More people have sold than really wanted to or intended to. The market has fallen further than it should have done, as justified by everything which is going on. And that's why when you get a recovery on the 2 out of 3 occasions, it tends to be a much stronger recovery than the fall itself, because in general, and this certainly applies to the silver market this time, the normal fundamentals which were applicable to the silver market, supply, demand, geopolitics, the debasement story, front-running what's coming with the government debt, all these stories are still out there. They haven't gone away. Nothing's changed. All that's changed was the psychology of the market in the blink of an eye. So probably if those underlying factors of supply and demand don't change, probably, and again it comes down, I want to say it's not an investment regulation, but 2 out of 3 chance we'll still move higher.
Despite the chaos, the core drivers of precious metals remain intact. Global debt continues to rise, mine supply growth remains constrained, and central banks, especially outside the West, are still accumulating gold. Meanwhile, recent quarters have seen significantly higher average gold and silver prices than those reflected in the last reported mining earnings. As upcoming results are released through 2026, they will likely capture 2 consecutive quarters of stronger pricing. Markets may swing violently in the short term, but earnings, cash flow, and physical supply ultimately anchor valuations. Volatility changes sentiment. Fundamentals shape outcomes.
In both cases, if we go back to the start of the year, but this is also applicable now, start of 2026, all these mining companies, the last reported profits we have are the profits to the 30th of September 2025. And that encompassed a period when from June to September, when the silver price and the gold price was considerably lower than we saw in the last quarter of 2025. So the quarter which hasn't been reported, September to December, generally saw much higher prices, much higher than the quarter which has been reported of June to September. And if the present prices of gold and silver hold, the precious metal prices in the first quarter of 2026 will be higher, much higher, than the average prices in the last quarter of 2025. Now, we don't know whether the gold prices, silver prices will go up or down or hold, but you can't do anything other than assume that they'll stay where they are until the end of the quarter, which won't be the case. But if they hold, we're going to have 2 consecutive quarters, the December quarter and the March quarter, at least, where the average selling price of these mining companies' precious metals will have been much higher than it was in the previously reported quarter. What that means is that in the next results, the December results will be reported in mostly a little bit in January, but mostly February, March, maybe some April, will be much higher for most. And then the following lot, which will be reported in July, August, September,